The IRS has a list, and most people have no idea it exists. It's a set of digital flags that can trigger an audit before a single human being ever even looks at your return. And if you're self employed, a freelancer, or a small business owner, you are statistically more likely to hit one of these flags than anyone else. Today, I'm going to tell you exactly what they are and what you can do to stay off the IRS radar for good. Hey, I'm Paulette with PRF Tax Service. I help freelancers, gig workers, and small business owners navigate taxes without the stress year round. Hit subscribe if you're new here because I post real practical tax strategies every Tuesday and Thursday that are designed to save you money and keep you out of trouble. Let's talk about how the IRS actually works. Most people picture an IRS audit as some agent sitting at a desk randomly pulling tax returns to review. That's not how it works anymore. The IRS uses a sophisticated automated scoring system called the Discriminant Information Function, or DIF score. Every single tax return that gets filed is run through this system automatically. The system compares your return against statistical averages for people in your income range and your industry. If your numbers look unusual compared to those averages, your DIF score goes up. The higher your score, the more likely your return gets flagged for review. This happens before any human ever sees your return. It's entirely automated and it's looking for specific things. Here are the digital red flags that can trigger that system. Red flag number one: unusually high deductions relative to your income. If you earn $60,000 and you're claiming $55,000 in deductions, that ratio is going to stand out. The IRS knows the average deduction amounts for people at your income level and in your industry. If yours are dramatically higher than average, it raises a flag. This does not mean you shouldn't claim legitimate deductions. You absolutely should. But it does mean your deductions need to be real, documented, and proportional to your actual business activity. Red flag number two: claiming 100% business use of a vehicle. This is one of the most common audit triggers for self employed people. The IRS is extremely skeptical of anyone who claims they use their car exclusively for business with zero personal use. If you're claiming 100% business use of a vehicle, you need ironclad documentation, a mileage log with dates, destinations, and business purposes for every single trip. Most tax professionals recommend claiming a realistic percentage rather than 100% unless you genuinely have a dedicated business vehicle that you never use personally. Red flag number three: home office deduction abuse. The home office deduction is legitimate and valuable, but it has very specific requirements. The space must be used regularly and exclusively for business, not your kitchen table where you also eat dinner, not your living room couch where you also watch TV. A dedicated space used only for work. If the IRS sees a home office deduction and audits you, they will ask to see the space. If it doesn't meet the requirements, the deduction gets disallowed and you could face penalties and interest on top of the taxes you owe. Red flag number four: consistently reporting losses year after year. If your business shows a loss, meaning your expenses exceed your income, for multiple years in a row, the IRS starts to question whether it's actually a business or just a hobby. The IRS has what's called the hobby loss rule. If your business doesn't show a profit in at least 3 of 5 consecutive years, the IRS may reclassify it as a hobby, and hobby losses are not deductible. If you're in a startup phase and running losses, make sure you're documenting your business activity, your intent to make a profit, and your efforts to grow. Red flag number five: large cash transactions and unreported income. Banks are required to report cash transactions over $10,000 to the IRS, but the IRS also receives 1099 forms from every company that paid you $600 or more during the year. If the income reported on your return doesn't match what those 10-9s show, that's an automatic flag. Always make sure every dollar of income you receive is accounted for on your return. Underreporting income is one of the fastest ways to get audited and one of the hardest situations to resolve. Red flag number six: Round numbers everywhere. This one surprises people. If every single expense on your return is a perfectly round number, $500 for supplies, $1,000 for advertising, $2,000 for equipment, it signals to the IRS that you may be estimating rather than tracking actual expenses. Real business expenses are rarely round numbers. $487.23 for supplies, $1,143.50 for software. Keep your actual receipts and report your actual numbers. Red flag number 7, excessive meals and entertainment deductions. Meals and entertainment are among the most abused deductions in the tax code, and the IRS knows it. Under current tax law, business meals are only 50% deductible, and they must have a legitimate business purpose. Entertainment expenses are generally not deductible at all anymore since the Tax Cuts and Jobs Act. If you're claiming large meals and entertainment deductions, you need detailed records: who you met with, what business was discussed, and receipts for every expense. Red flag number 8, filing late or inconsistently. Consistently filing late or filing amended returns multiple times draws attention. It signals disorganization and increases the likelihood that your numbers will be scrutinized more closely. File on time, every time. If you need an extension, file for one. But remember, an extension to file is not an extension to pay. You still owe any taxes due by the original deadline. Now, here's the most important thing I want you to take away from this video. Having one of these flags on your return does not mean you will be audited. It means your return may be reviewed more closely. And if you have legitimate deductions that are properly documented, you have nothing to fear from an audit. The goal is not to avoid claiming what you're entitled to. The goal is to make sure that everything you claim is real, accurate, and backed up by documentation. Keep your receipts, track your mileage, document your business purposes. Keep your personal and business finances completely separate, and work with a tax professional who knows what they're doing. If you want to make sure your return is audit proof, I have free 15-minute consultations available. The link is in the description. Let's look at your situation together and make sure you're claiming everything you're entitled to and nothing you're not. And grab the free tax savings checklist in the description. It's a great reference for making sure you're capturing all your legitimate deductions the right way. Drop a comment below and tell me, did any of these red flags surprise you? Was there one you didn't know about? I read every single comment and I want to hear from you. Subscribe if you haven't already. New videos every Tuesday and Thursday. I'll see you in the next one.